Seems like the lessons so far have been core business is pretty solid.
Yep.
Credit looks okay.
Yep.
And the trading activity in December, we all understand.
That's it. The greatest fears didn't materialize in the fourth quarter. As you know, after the third quarter, there was a sense that growth was decelerating. We took, on average, bank earnings growth estimates down from about 10% to 7%. There were concerns it could be something much worse. And I think what you're seeing today and yesterday is actually somewhat of a relief rally, which is none of those worst fears are materializing.
Is the story, do you think that it's turning into a 19 story of growth, of loan growth?
There will be loan growth, but everything is going to happen just slower, in our opinion. A lot of the biggest catalysts for the economy or for the banks are behind us. Doesn't mean things aren't still going to be good. We're looking for 7% earnings per share growth, yet the stocks are probably 15 to 20% cheap relative to where they normally trade. 7% is not that bad.
Some people are looking inside these earnings and wondering what comes next. Are there any clues for the future in terms of credit loss provisions or the tone that the executives are striking, perhaps?
So I do think these stocks are attractive and they're undervalued, but also you want to be realistic. Credit just can't get any better. We've been saying that for some time. You're going to see net charge-offs go up. You're going to see non-performers go up. It's a natural thing to have happen. The question, I think the comment is that the banks are very well prepared to do with it. Capital's the highest ratios in almost 80 years. The banks are buying back a lot of stock so they can manufacture a lot of earnings per share growth on their own. So I think it's just not going to be as robust a growth, and they're operating at a much higher level of profitability.
Those buybacks, Jim and I were talking about it earlier. Goldman buys back stock at an average price of $236. B of A much closer to the current market price. They don't always have the same net impact, and sometimes in retrospect they can look bad. Do you still think we're going to see this pace of buybacks continue?
I think it's accelerating.
Why?
It's accelerating for a variety of reasons. One is the companies are profitable and they're generating a lot of excess capital organically, so that's going to fuel it. The second thing is it's taken Washington a while to implement Dodd-Frank. I think now that we're getting to a little bit more of a regularity to how they review the stress tests, that there's a little bit more of a recalibration. These banks still have a tremendous amount of capital, but I think they're going to be able to share more of it with their shareholders. And so slower growth in the economy, a little bit of recalibration on the regulatory side, and you're seeing buybacks accelerate. And we saw it. And also what's happening, David, is a lot of banks were in the blackout period during the big market sell-off. So they're coming back in earnest. We saw Synovus just this week enhance their program.
Dividends too? I mean, you talk
Yes.
about returns to shareholders.
So the way we measure it is total return of capital to shareholders. For the biggest banks, it's going to be 100%. They're going to take 100% of their earnings and they're going to buy back stock or pay it out in dividends.
So I was just going to ask about the biggest source of growth. Is that consumer loans at this point?
The consumers is still growing, and remember, we had a good retail figure. The consumer, I think, feels good, employment's good, wages are up, so I think consumers okay. The biggest numbers, really, for a lot of these banks that are swinging the results are the corporate returns. Third quarter was a really sluggish, surprisingly slow loan growth quarter. Looks like December of this past year, was a pretty good period. So we're seeing pretty good end-of-period loan growth. But I'll tell you, we've taken all our loan growth estimates down, and that's partly why we cut our estimates to 7% growth instead of 10.
Solomon's making some comments on 1MDB, says it's been a difficult time, but the franchise in Asia remains strong. Does the street understand that story yet?
So it's going to take a while. Our analyst call there is that when we see something like this happen, it's literally years before it comes to a conclusion. But what happened is Goldman was trading below book value when the stock closed last night. So trading below book value is just too cheap. I really think it's going to be hard to see that stock go on a sustained rally until that gets resolved. But below book value, Goldman, especially with these results, that stock was just too cheap.
Finally, we were talking off camera about just the trading activity in December and all of the excuses people were giving for why that was happening, right?
Yeah.
Volcker rule, balance sheets, liquidity drains. What have we learned from that, if anything?
We experienced it, and I think a conversation that's going to be happening more throughout this year is active versus passive management. Passive management can take over the market. So we saw $7.5 billion flow out of financial services ETFs since June. And also there's just a lot less liquidity. I think that's a byproduct of the Volcker rule. You're seeing equities just have less liquidity. So directionally, the technicals can take over a stock in the short term. And I think it'll create opportunities for long-term active investors, both on the upside and downside.
Tom, come on, we've been hearing that for years, and it hasn't. The active guys continue to not put up the numbers.
Well, when you say that with that question, the good news is we're closer to it happening. They haven't put up the numbers. I still think there is a place for ETFs in everybody's portfolios, but I think that this just keeps growing as a percentage of the volume. And it's, I think, will create opportunities for more active managers. It won't mean all of them.
Understood.
But there will be opportunities.
Dislocations as a result.
I mean, I'll go back and tell a story. There was a story
Please.
that when tax reform happened in the banking industry, banks in the industry performed really well, including the Bermuda banks that had no impact from tax reform. Makes no sense. Or you look at the valuation of the largest members of the financials in the Russell 2000 versus the valuation of the smallest members of the Russell 1000, there's a difference. Why is that? It's because the passive impact is a plus for valuation at the top end of the 2000, and it's a minus at the bottom of the 1000. For folks who pay attention, which is what we do every day, we try, it's an opportunity.
But it sounds like you think that that pattern we saw last month could repeat itself.
I think that we got to live with this for a while until something happens with liquidity. Now, there was tax loss selling, and look, the concerns about macro issues are real. The economy is slowing. I think market structure needs to be more of a conversation. We are, I think, the world's biggest and best organized capital market. It should be better than what's happened at times, and I think we got to pay attention to what regulation was done that was implemented.
So you're
and how
talking
it
a
might
little
be
bit about
calibrated.
Volcker and the lack of liquidity, then, not just the incredible growth of ETFs and index.
I believe Volcker was made to change the risk that we're taking in a lot of off-balance sheet items in some really big markets, not to have less liquidity in small cap stocks, which is what's happened.